Hey there, and welcome back to our channel. If you're new here, I'm glad you found us. Today, we're diving into a topic that might sound a bit complex at first but is super important for anyone interested in bond investing. We're talking about yield. So, whether you're a beginner looking to learn the basics or someone with a bit of experience wanting to brush up on your knowledge, you're in the right place. Let's get started. Now, you might be wondering, what exactly is yield, and why does it matter in bond investing? Well, buckle up, because we're about to break it down. First things first, let's define what yield is. In the context of bond investing, yield refers to the return you can expect to earn from a bond. It's a way to measure the income generated by the investment relative to its price and can be expressed as a percentage. The yield can help potential investors compare different bonds or evaluate their investment options. But remember, not all yield is created equal. There are several types of yield you should be aware of when investing in bonds. Current yield, this is the simplest form of yield. It's calculated by taking the bond's annual interest payment, also known as the coupon payment, and dividing it by the bond's current market price. For example, let's say you have a bond that pays $50 in interest each year and is currently trading at $1,000. The current yield would be calculated as follows: current yield equals 50 divided by 1,000, which is 0.05 or 5%. So, in this case, your current yield would be 5%. Yield to maturity, and now, this is where things get a bit more interesting. Yield to maturity is a more comprehensive measure that takes into account not just the coupon payments, but also the total return you'd earn if you held the bond until it matures. YTM considers the bond's current market price, par value, coupon interest rate, and the time remaining until maturity. It's a bit more complex to calculate, but it gives a clearer picture of your potential return. For example, if you have a bond with a face value of $1,000, a coupon rate of 6%, and it has 10 years left until maturity, trading at $950. The YTM would be higher than 6% because you'd be earning the coupon payments as well as the difference between the price you paid and the face value at maturity. Yield to call: if you're investing in callable bonds, you might want to look at the yield to call. This yield measures the return you can expect if the bond is called before its maturity date. Callable bonds can be a little tricky because the issuer has the right to redeem them before maturity, usually when interest rates drop. So, if a bond is callable in 5 years, YTC helps you gauge your return if the bond is called at that point instead of going all the way to maturity. Yield spread. Now, let's touch on yield spread, which is particularly useful when comparing different bonds. The yield spread is the difference in yield between two different bonds, often between a corporate bond and a government bond. For example, if a corporate bond has a yield of 7% and a comparable government bond has a yield of 3%, the yield spread is 4%. This can help you assess the additional risk you're taking on with the corporate bond compared to the safer government bond. Understanding these different types of yield can help you make more informed decisions when it comes to bond investing. A higher yield often indicates higher risk, so it's always good to do your homework and understand what you're getting into. To wrap things up, yield in bond investing is essentially the return you can expect from your bond investment, and it comes in various forms, including current yield, yield to maturity, yield to call, and yield spread. Each type of yield provides valuable insights that can guide your investment choices. If you found this video helpful, please give us a thumbs up and subscribe to our channel for more educational content like this. And if you have any questions about bonds or yield, drop them in the comments below. We love hearing from you. Thanks for watching and happy investing. See you next time.